I want to take you back into this area here. Focus on this little segment of price action right there. Do you see anything that stands out? We're going to focus on this little area. And why am I focusing on this area here that's shaded in? From this high down to that low, and then how we start to deliver going back up. Because the trust is that there's no necessity to go back down into this area, which is a breakaway gap. Because this line here is your bullish breaker. Everything is indicating that order flow is supporting that idea. So watch this shaded area. This is the 5-minute chart. Now we're going to transition into a 4-minute. Notice any changes in here. Now we'll look at the 3-minute chart. It's a 2-minute chart, same range, but it looks different, doesn't it? And then finally down to the 1-minute chart. Now, this green line here, again, is the hourly bullish breaker, that high. We dig into it here 1, 2, 3 times, and then we have a swing high broken to the upside. The last down close candle prior to that shift in market structure, that down close candle is a bullish order block. That opening price is a change in the state of delivery. The change in the state of delivery is when that candlestick's opening price is crossed right there for the first time. When that happens, then and only then, never before, never another time in the future, that validates this down close candle as a bullish order block. Now, why? What makes that an order block? The fact that we have this bullish hourly breaker, the fact that we traded down into it, and then we see a shift in market structure. Then we go back to the down close candle, the last one, prior to a run higher that has a shift in market structure there. I don't care if this candle started here, it opened here and went down, or if it opened here and went down. I would draw it right on the opening price. This becomes a bullish order block as soon as that candle crosses it, the opening price. That's the change in the state of delivery. As soon as that occurs, this low should not be violated. So you can now start looking for bullish PD arrays that are in discount. Well, everything's in a discount now because we're so far down. But we have a down close candle right here. So we can use that opening price, extend it forward. Anything in there, buying this, anywhere in this area here, buying that, you can buy that with a stop loss right below there. But look closer. We are now looking at that price range from this high up here all the way down to that low. We trust that that low will not be violated. Why? Because this candlestick was crossed right there. Now what happens, let's play devil's advocate, what happens if it breaks that low? Okay, then you have to continuously study price action and wait for that same instances where we see a shift in market structure to the upside. In the last down close candle, we'll mark the opening price, and if there's a candle that goes above it, that validates the down close candle as a bullish order block. This is only one form of my bullish order block. So we have the ranges here. 75% of the range is a gradient, 50%, and then 25%. So I want you to notice how as price works very close to the 25% of that range, again, the range is the high to that low, we are trusting that it wants to go higher now because we have a change in the state of delivery. When that candle starts moving above that opening price, now we have it. It's in place. We have a shift in market structure. All lights are green for going higher. Look at price. Order flow. What kind of order flow? Institutional order flow. Easiest, right to the chase, no bones about it. Easiest thing is if we're bullish, we want to see down close candles support price. If we see a short-term low taken out, we expect to see that as a stop run, and then price should revert right back into going higher right away. And everything I just said, reverse it for when the markets are bearish. We have a down close candle here. Draw it out in time. Does price support at that level? Yes. 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 Does it start moving higher? Yes. Does it take out short-term highs? Yes. Yes. Down close candle. Is price supporting it as a bullish order block? Yes. It's not going below it. Does price go higher and take out high? Yes, it does. We have a down close candle. Does price go down into it and reject that area and leave it and break a high? Yes. Down close candles here. Why am I picking this one? Because it's above this high here and this high here. So does it support price? Look at it. What happens when it hits it? Starts going higher. Does it take out a short-term high? Yes, it does. So is order flow bullish or bearish? It's bullish. What is it reaching for? A premium. Relative to what? The range, which is this high to that low. That is determined by this level here, which is equilibrium. At that level or below it is what? Discount. At that level or above is what? Premium. So when we get above this 50% level, it's far less probability, more risk if we start taking order blocks and buying them above this level because we're in the premium range of this high to low. Doesn't mean it can't keep rallying. It just means that we have to do all of our buying below equilibrium or less while we're in a discount. That's the framework for high probability. Short-term lows being taken out, we expect that to be rejected and start seeing price go higher. We start to see it run higher here. Does it find support on this down close candle here? Yes. Sends it higher. Does it take out a short-term high? Yes and yes. We have a down close candle here, right around equilibrium. No return back to it here. That's fine because we're in that area where it's a short-term premium. Down close candle here. Look at the body supporting that idea and then rallies higher. there? Highs are taken out. Down close candle, does it support it as bullish? Yes. So when I'm watching price and I'm on side and I'm expecting prices to go higher, I'm looking at every down close candle as a means or mechanism to support price, or any swing low is a potential stop run. So I'm not in a hurry if I'm long to ram my stop loss between some random swing low, because that's exactly what the algorithm is going to do. It's going to sweep below them like it does here, like it does here, and like it does here. And then once it does that around equilibrium, then it's going to go into another price leg higher. And then we enter a consolidation. What's below here? Sell stops. Now we can go higher. Notice also that we have all of these fair value gaps. When we have a change in the state of delivery and we enter a buy program, which is where we are from this point on there. Well, what's going on here, Michael? It's just retracing. That's all it's doing. It's allowing for a deeper discount with that low staying intact. When this high is taken out here, notice that we have another return back into this order block. When we have this retracing back in the order block here, that's when we start seeing the more pronounced run higher. But look what's occurring here. All of this imbalance here, what is it lacking? Buy side delivery, not liquidity, buy side deliveries when there is a run higher in price. Look what it's doing. It runs higher. Look at the bodies respecting what? The inefficiency's high right there. This SIBI, that candle's low. What is it respecting? This candle's low. Now what is it dropping down into? Consequent encroachment, midpoint of this candle's low and this candle's high. There. Rallies. Where's it rally to? The fair value gap right here. So how do we use this information? They're inversion fair value gaps. These are like a mountain climber, and the mountain climber is climbing up the surface of the mountain, and he's looking for those little pockets to stick his fingers into and stick his toes on to find footing and grasp a new finger point or holding point. This is the mountainside here. And this is the most sheer drop off. So this is the smoothest part in that drop off. So we have to use these areas to find what? Footing. There's little pockets. We have to wait for them to form. That means consequent encroachment, short-term low, trades below. What's it going to do? Trade back into this order block and take out that short-term low for sell stops. I want to see it react at that order block, and then also that it's taken out liquidity, and there's also a volume imbalance right there. So fair value gaps like this, if we're bearish, we expect it to go up there and sell off. But when there's a change in the state of delivery, we expect the market to go up. So all these down movements here, it's lacking what? Buy side delivery. So it's going to want to gravitate up into them. If it ever retraces into them, once it closes them in, we treat them as what? Inversion fair value gaps. So we see this consequent encroachment, which is midpoint of the shaded area, midpoint between this low and this high. Here, we rally up to what? This gap. We're treating it as an inversion fair value gap. Does that mean it's going to trade right here and go higher right from there? No, we have to wait and watch. What is this here? This is a buy side imbalance, sell side inefficiency. What is this right here? It's a swing low. We've had a nice move outside of the range of these relative equal highs, and we're into two inefficiencies, this one and this one. And now we have a short-term low. It's probable, not guaranteed, it's probable that it's going to run for short-term sell side liquidity. Stop hunt. That's what we're getting from here. It drops down, takes out that liquidity, also respecting consequent encroachment of this fair value gap, then rallies. It rallies to this high and through this inversion fair value gap, comes back down, support, rallies back up. What is it creating? Short-term low. So what's going to be trailed up right behind that? Sell side. Where are we at in the range? Here's equilibrium. We're right there at equilibrium. When this occurs, equilibrium is where you're going to anticipate, you're going to predict, you're going to expect a stop hunt. That's what the algorithm will do. A run on stops. This one is 2 times, but returning back into what? This fair value gap, which is an inversion fair value gap. You would take this, extend it over. What is it respecting? This order block still, that's a reclaimed order block, but it's also in concert with this candlestick's low. It's respecting that old gap. So that makes this an entry off of what? This inversion fair value gap right here. The market finds support here, rallies, takes out the high, and trades up into what? The next gap over here, which will be treated as what? An inversion fair value gap. When we drop down, we're taking out sell side here, and we're doing what? We're rallying off of the low of this fair value gap. So this candlestick's high, that's what we're respecting over there. Look at the bodies. It's telling you the story. It's supporting the idea that that is still the underlying narrative. Stops have been taken, control mechanisms are in place, the algorithm is absolutely respecting that old fair value gap right here. Rallies, order block, touch it. Does it rally higher? Yes. Does it take out a high? Yep. It's liquidity and inefficiency. It's discount and premium. Time of day. All these things come together to make a beautiful tapestry, and you're never surprised, and you're waiting for them to form.